If you're a trader who's tired of failing combines, you're probably going down the YouTube rabbit hole looking for the perfect strategy. You find ICT, the fair value gaps, liquidity, order blocks, displacement, market structure shifts, and supply and demand. And at first you're excited because you think this is it. This is what I've been missing. So you spend hours watching YouTube videos, taking notes, marking up charts, and then you open your chart up the next morning and you're even more confused than you were when you first started. Now you got 15 different things you're waiting for before you can take a trade. You see it for value gap, but you're waiting for liquidity. You see liquidity, but now you're waiting for displacement. Then you miss the whole setup, so you chase it. You take a loss, and now you're frustrated. So you start looking for another setup. And this becomes a cycle. You learn a strategy, confidence is high, a couple losses, doubt creeps in, back to YouTube, new strategy, and then repeat. And meanwhile, your combines are getting burned. You might have failed one, maybe another, maybe even failed five. Maybe you actually passed before and got a payout, but you can't replicate it. And that's the most frustrating part because you know you're capable of doing more and doing better. You've seen yourself make money. You've seen yourself get close. You probably even had those days where you think I finally figured this out. And then a week later, you're back at zero, buying another combine and wondering what went wrong. At some point, you have to stop asking what's the next strategy I need to learn and start asking what's something simple enough that I can actually follow. That's what I think most struggling traders are missing. Not more information, less noise, more clarity, and a process they can actually trust. So please do yourself a favor and stick through the entire video, because this simple setup can be your last. But before I show you the strategy, let me tell you exactly why this is worth your time. So I've been trading for 4 years. I've easily passed 20 plus trading combines, and I've passed roughly 90% of those with only 2 trades in about 2 days. I've also received multiple payouts from funded accounts. But more importantly, I'm not the only person who's been able to make this work. I've had multiple students pass their combines while working with me, including traders who were able to pass their first combine within the first week of working together. I've also had students receive actual payouts following this exact simple setup. And that's important to you and I because I want you to have something you can actually recognize, execute, and repeat over and over. So I spent years testing different strategies, overcomplicating my charts, trying different approaches, and figuring out exactly what matters. So that's what eventually led me to simplify my trading strategy down to market structure and the 13 EMA. So I'm not telling you this is some magic strategy that's going to make you rich overnight, but I'm showing you a simple system that I personally use that has helped other traders implement to build over time. All right, first things first, the thing about market structure, you must understand trends. Let's go over uptrends, downtrends, and ranging markets or consolidation. So an uptrend is where price is creating higher highs, higher lows, higher highs, higher lows, higher highs. Now, I want you to answer this to yourself. What is the easiest way to actually make market in this? Buying or selling? Buys, of course. So when the market is moving up, this is a uptrend. Again, a uptrend. When the market is creating higher highs and higher lows, we look for buys. Now, the opposite of this, looking like the same exact market, but moving downwards, is downtrends. When price creates lower lows, price is creating lower lows, lower highs, lower lows, lower highs, lower lows. Now, again, this is a downtrend. And when the market is creating downtrends, what is the easiest way to make money is when we're selling. Now, these are two important markets, uptrends and downtrends, but we can't ignore the third type of market, which is a ranging market, which is consolidation, where there's really no higher highs or lower lows. Price may create, a lower low here, but come here, and then boom, boom, boom. Long story short, price is going by its own rules and not following an uptrend or a downtrend. And in this market, you do not want to trade prices hitting tops and prices hitting equal tops and equal bottoms. As you can see right here, we do not want to trade in this market because ultimately price is moving sideways. This is what I call see this my text there. This is what I call a ranging market. Now, how do we trade ranging markets? Well, I'll make it easier for you. We don't want to trade in a ranging market because that's where our money is not made. We get caught up, we hop in here, and then we probably get taken out somewhere around here. Or you think we're buying here, and then price reverses, and then we're selling here, and then price reverses, and then you're just stuck in this big fat tunnel of poop. So we do not trade in those type of markets. What do we do trade in? We trade in uptrends and we trade in downtrends. Now, let me show you exactly before I show you exactly what I'm looking for, let's go over what this is actually called. Let me show my tool all right, there we go. what this is, what this is, what this is, and what this is. This right here is called a swing high. This right here is called a swing low. Swing high, swing low. Now let me show you what this again looks like on a downtrend. Swing this, let's go over what this is, what this is, what this is, and what this is. Nothing different. Swing low, swing high, swing low, lastly swing high. So now that we know what our swing highs and our swing lows is, the easiest way to see this on a chart is, say you have, let me draw it for you. Say you have 3 candles here. This is candle 1. Let's get my tool here. Say this is candle 1. Boom. And then say this is candle. Say you have some more candles down here. And then you have a candle 2 here. And this is going to be a green candle, by the way. Let's see, let's change this color to green. So it's going to be a bullish candle. And then say you have one more candle. So the easiest way to identify your swing highs and your swing lows is when your candles look like this. See, draw this last candle real quick. Boom, boom, boom. Let's change this back to red so you kind of get the idea. Boom. So it's when your candles look like peaks. So when you have peaks and valleys, your peaks and valleys. So price, say price is this, so like boom, this is a peak right here. Peak right here. There's no candles here. There's no candles here. There's just, prices pushing up, and then we peak, and then prices pushing back down. So when you see your peaks, again, your peaks are going to be, let's clean this up a little bit. Move over. So when price again looks like that, that's what it's gonna actually look like when the candles. So in the uptrend, boom, boom. So when your peak looks like this, and there's no more candles around it. So let me find a live example real quick so it's a little easier for you to understand. So like right here, this is a peak. This is a peak. This is a peak. This is a peak as well. This is a peak as well. This is a peak as well. Now, what are these peaks? Again, swing low, swing high. This is a peak. Swing low, swing high. This is a swing high. This peak right here. Another swing high right here. Another swing low. So this is where your peaks are, your important peaks. So like the peaks that actually stand out and price is not around. So even though price pushed up right here, this right here is not a peak because price is continuing from here. Where price creates again, like my 3 candle example. Go back to where we see, let's find it. Back to my 3 candle example when price is pushing in one direction and then boom, there's a peak. When the peak is created, it's like in real time, price is creating a peak right here, a swing low to create a swing high somewhere around here and then continue pushing down. That is your swing highs and your swing lows. Now you might be wondering, okay, you just went over that. Why is this important? Because this is where we want to hop in our trades. But we're in an uptrend. If you ever heard this saying, buy high, sell low, what we want to do, we want to, buy low, sell high. Buy low, sell high. Sorry about that. So this is what we're actually doing. Wait for price to push up. And then when price comes back down, we want to buy low. Price goes up. This is where you're taking profit. This is where you're making your money. Price comes back down. This is when we want to buy low. Again, boom, you're collecting your profit. So we look for these swing lows, boom, boom, to catch the next move going upwards. And that's where ultimately we are going to make our money. That's supposed to be a money sign. And then, okay, that's easy to understand in a uptrend. What is it like in a downtrend? Well, boom, boom, boom. Again, lower low, lower high, lower low, lower high. What are we looking for? We're looking for swings. Boom, swing highs. So in a downtrend, we're looking for swing highs to enter. And let's write this down so you can write this down. Again, write this down as I type it out. So in a downtrend equals we enter on swing highs. Oh, swing. Oh man. Excuse the typing. So boom, in a downtrend, we look for swing highs for entry. Now again, likewise, in a uptrend, we look for swing lows. What are swing lows? They are higher lows. In a downtrend, swing highs. What are swing highs? They are higher lows. So write this down. This is very important. In a downtrend, so like here, we look for swing highs, which is again right here and right here, which are higher lows, which again are right here and right here, which again, my tool go up here and here. These are our higher lows. These are our swing highs in a downtrend. What do we look for there? We look for entries. Let me move this back over here. So price creates a lower low, wait for a lower high to get in. And then we collect our profit as it goes down. Price pulls back, create a higher low or a swing high, and then that's where we enter. And then we collect our profit going down, following the trend. Now imagine imagine you have, imagine this is the beach right here. This is the sand. You're chilling, you're drinking your mimosa or whatever, and then this is the water. You're in the ocean. This is the ocean. Beach, and then the hotels are back here. You're in Miami, the hotels are back here. Now, say the waves are going this way, and you're trying to get somewhere. It's easier to swim this way than it is to swim this way when the current is going that way. Now, it looks a little confusing, so follow along. What I'm trying to explain here is oh, one sec. It is, where's my text box? It's easier to make money riding the wave. And why is it? Because I could just say it and tell you it's easier to make money riding the wave. Why is it easier to make money riding the wave? Because we're not the ones creating the splash. Retail, which is like people like me and you, don't create splashes. Who creates the splashes? Banks, institutes, big effing money equals splashes. And what do we want to do as little retail? If you put $1 million to took on a trade, you would not move the market at all. The banks, the institutes, people moving trillions and trillions of dollars, millions and millions of dollars, billions and billions of dollars, billions, millions, trillions. The people who actually make these candles move are the ones moving the market. So why wouldn't we want to get in with them? Why wouldn't we get in with them? So price pushes up because they're thinking the same exact thing. Say, let's restart this. Say Chase Bank pushes the market up. Boom. But the little branch of Chase or like Huntington is like, yo, Chase, like, let me hop in. All right, bet. This is what I'm going to do for you. We're going to pull price back in a little bit. Now you can't get in where we got in. Boom. But we're going to let you get in somewhere so you can ride the next wave with us. Boom. Now let me see. What's another bank? Well, JP Morgan is Chase. What's another bank? Discover or Capital One or credit card, whatever. The next institute. It's like, can we get in? All right, cool. Now you can't get in where Huntington got in, but you can get in here. Boom. Boom. And then this war here. Now, we're not JP Morgan. We're not Rockefeller. We're not none of them. We can't move none of this. So what are we doing? We grab our little piece of the pie. We wait to see where they're pulling back from, and we hop in and we catch a ride. We hop in the whip. They don't know we're in, or they know we're in for sure, but they don't care. And we're only grabbing a couple of dollars compared to what they're doing. We just hop on the ride and we ride the wave. Now that is market structure in a nutshell and what we look for in my strategy to trade market structure. Now the 13 EMA. Let's go right into that. So 13 EMA, let's hop into the market here. See if I can find it. 13 EMA is the exponential. Let's clear my chart here. So you can write this down as well. EMA equals exponential moving average. Here we go. Exponential moving average. Okay, what is the exponential moving average? Exponential moving average is just the sum, and especially so I trade the 13 EMA. 13 EMA. It's the sum of the last 13 candles. That's all it is. The sum of the last 13 candles. So 200 EMA is the sum of the last 200 EMAs moving direction. So as you see, price here is pushing down again. This white line here is my 13 EMA. White line here is my 13 EMA. Now, real quick, let's move backwards a little bit. Now, okay, I see what an EMA is. I now know what an EMA is. How do I add on my EMA? So what you're going to do here in the, make sure you guys can see here. In the, let's move my chart a little bit. Boom, let's make it make sense for you guys. All right. So boom, in the top left here, let's go to a clear chart so you can see it. Make sure you're paying attention as well. This is game right here. So in the top left here, if I can draw, boom, top left here, excuse my arrow, that's where we go. So if you don't have it already here, like I have 3 EMA crosses, but I only use the 13, which will actually go here. First, you'll go to indicators, boom, click indicators. This will load up, and I have 3 EMA crosses. You can use the exact one I use, or you can just look up EMA cross. EMA cross, you can add any of these. Again, this is the one I use by, let's see, Ookla, OOKLA 1977. That's the one I use. 3 EMA crosses, but I only have 1. And then in the top left here, again, you have my crosses here. You're going to go ahead and click the little thing that looks like a bolt that says settings. And then your input is going to be 13. And then style, you can change whatever color you want for it. Make sure this is selected. So once you have that, go ahead and click OK. And then you have the 13 EMA. Now, the reason I use the 13 EMA is, first things first, I just have higher win rate with it compared to 9 or the 500 or, you know, whatever ones you're thinking about. Now, how do I use this? Grab my tool. How do I use this 13 EMA as support and resistance? So now, if I wanted to catch every single swing and pullback, looking in hindsight, you're trying to tell me that in real time, you know that, boom, this was going to be the move that created this move. No. Do you know the move that this move right here is going to be the move that created this move? No. Also, you don't want to hop in. Last thing you want to do is hop in. Let's see, let's find an example. You don't want to hop in here, which even though this is a uptrend, you don't want to be, you know, actually, no, you would want to be up here because this is a swing low. You want to hop in here, and you don't want to, boom, go for buys here, but now you got cooked coming down here. So how do we find the A plus and differentiate our trades? I use my 13 EMA. What I need price to do off my 13 EMA, again, write this down. If you don't have a notebook or anything as such, make sure you have that. See, perfect example right here, easy to find. What I need to happen off this 13 EMA, I need price to do this beautiful, beautiful thing right here. See, we'll start new. I need price to respect my 13 EMA. That's all I'm asking. Just please, price, come to my 13 EMA and respect it. So price, let's break it down. Let's get to the live examples here. So you understand the 13 EMA, you understand what the 13 EMA is. Now let's break down exactly what I'm looking for off the 13 EMA. So I need price to come back to my 13 EMA. So first things first, let's determine the trend. So here we're in a uptrend because we have swing lows, swing highs, again higher lows, swing low, swing highs, higher low, higher high. Now that we got that out of the way, we know we are in an uptrend. So what are we looking for in an uptrend? Buys. Now what are we looking for in an uptrend? We're looking for price to push up. Okay, price push up. Maybe I didn't catch that move. We're waiting for price to pull back now. And again, we can't just call and catch every single pullback, because all price does is up, down, up, down, up, down, up, down, up, down. Price has nothing but pullback. So how do we differentiate a B plus or a wacky pullback to the best clean pullback to hop in and not have our stop loss get hit all the time and, to win? We look for price to come back to our 13 EMA. So boom, price comes back to our 13 EMA. Clear my chart a little bit. Price perfectly pulled back to the 13 EMA. Boom, grab my marker here. Price pulls back to the 13 EMA. And what does price do off the 13 EMA? It wick rejects off the 13 EMA. And then that's where we start to catch our next move going up. And that's when we're able to, boom, catch that next wave up. So that's what we look for when we trade price. Now let's go to some, let me actually show you some better yet. Let me show you some examples. All right, now that you guys understand market structure, you guys understand the 13 EMA a little bit, let me go ahead and show you some trade examples so you guys can understand how we use it for market structure plus 13 EMA and make some money. So if you're not already in the Discord, go ahead and check out the links down in the description to join the free Discord there. You'll be able to see exactly what I'm showing you guys now. You guys can, see how the group eats or recent trading wins. And then, but most importantly right now, let me go ahead and show you these trade breakdowns. So break down some of these trades. So this is trade number 1. Again, you guys get full access to this in the free Discord down in the link below, so you can see exactly what I'm talking about. By the time you watch it, there might be 100 more trades in here. You can study yourself to actually understand the strategy, because I break it down as simple as I can in these examples. So this is the first example. Price step first. First things first, we need market structure. We need structure. Price either needs a new higher high or lower low. So price, boom, come up here. It broke this high over here, pulled back higher low. Price created a new higher high. Step 1, higher high. Step 2, a pullback and rejection off the 13 EMA. Here comes our 13 EMA. Price then pulled back to a 13 EMA. And as you see here, right there, that's where we started to say, okay, let's look for step 3. Enter on BOC, which is break of candle. Now our break of candle is say we're in an uptrend, or candle step 2, pull back and rejection out the 13 EMA. Once that happens, like this candle right here, once that candle closes, we look for our entry at break of candle. And the uptrend is going to be the top of that candle, and the downtrend break of candle is going to be the bottom of that candle. And as soon as I use stop orders, by the way, write this down, I use stop orders, because as soon as this candle closes, I want my entry ready to get there exactly when candle breaks right here. That's when I entered. So this was trade example number 1. Let's go over a few more. I got time today. Let's do it. This is another example. Zoom in here. Step 1, price created a new high. See, price was previously, creating lower lows, lower highs, lower low, boom, lower high, lower low, boom. But price reverse. This is market structure reversal. Break of structure in the market. When price was, let's go to an example. When price is, see chart back, when price is also important to know. Say price is in the uptrend. Boom. How do we know when price is ready to reverse or price ready to go in the downtrend? It's when price starts to break the other way. Now this is at first we were in an uptrend, and what will usually happen is price will create an uptrend, move sideways, and then come down. That's what sometimes happens. So what we do, we catch our buys here. During this time here, we don't trade, and then we catch our sales here. So we catch our money when we're going up, ignore when we're going sideways, catch our money when we're going down. Now in this example, price clearly was reversing. We avoided the sideways movement here. Price was going down. There was a clean, beautiful sell right here. Price was going down. We didn't get the sideways movement. Price started to reverse and go up. So price created a new high. That's what we look for. Step 1, price created a new high. What does that mean? Price creates higher highs and higher lows, higher highs, higher lows. We look for buys. Price did so. Step 2, price pulled back to my 13 EMA and rejects. Price came back, tapped my 13 EMA, and then rejected. And then step 3, enter at break of candle. When this candle broke here, that's when we got in. And then as you see, all we needed a small sliver, but the rest was history. Let's go to the next example. A sell setup. Beautiful example. Step 1, price created a new low. We broke this low here, broke a little bit of lows here. Price created a new low. Step 2, zoom out a little bit so it's easier to see. Step 2, pull back and rejection off the 13 EMA. As you see, this candle right here, boom, price it actually started with this candle here. This thicker one, price, boom. But what we didn't get, so this candle right here, again, if you can see it, taps my 13 EMA, rejects. Break of candle is here. It's important. My confirmation, my entry, entering the break of candle. We didn't get a break of candle here. The next candle, still respecting the 13 EMA, again, comes up, rejects the 13 EMA, closes. Where's our new break of candle? Right here. Stop loss goes above the wick in the sell, below the wick in the buy. And then as you see, the rest is history. Again, just to go over that, in a buy, stop loss goes below the wick, and in a sell, stop loss goes above the wick. Now, I could keep going on and on with these. I have hundreds and lots of examples. Go ahead, just join again the free Discord link in the description, and you can come in here and study these. And then also you could talk to me in the members lounge, and in the members lounge, go ahead and ask me a question, and I will answer that when I can. It will get you squared away. Boom, boom, boom. So that's how that is. Now that's exactly how I use market structure in the 13 EMA to make some motherfucking money. So if you have any questions, go ahead, drop it in a comment or join the Discord. You can message me in Discord, or come say what's up to the family. That's all I have for this video. Let's get you guys to the next one. Peace.